So a central bank has assets, which, in the older days used to be, say, gold, for example. Now they're, often government bonds, mortgage-backed securities, other things like that. And then they have liabilities, which are the monetary base of that country. And so the United States, the Federal Reserve's monetary base, their liabilities, that's the monetary base of the country. That's basically base dollars. Like at the end of the day, that's what a dollar is. It's a direct liability of the Federal Reserve. And so you can have that in two primary forms. One is physical banknotes, right? If you hold physical cash, it's a direct liability of the Fed. And two, banks store their cash with the Fed in digital form. It's just an entry on the Fed's ledger, and that's a direct liability of the Fed. And so those two components make up the monetary base. And then what banks do is they essentially multiply it. So when you have a deposit at the bank, you have an IOU that is for $1, but they have way more IOUs than they have base cash, because they know that most people are not going to all redeem them at once or even try to. And so you basically have this fractional reserve system. And there's actually, I didn't go in this article, but then the third layer would be international, euro-dollar system. Basically, you can have a foreign bank, they have a deposit at a domestic bank, and then they further fractionally reserve it for, people that might be holding dollars with them. And so you have a series of fractional reserve IOUs built on fractional reserve IOUs that at the end of the day are a claim on the liability of the Fed, or in another case, if it was Bank of England, whatever the case may be, that liability side of the central bank is the monetary base of the country. If you look at a commercial bank for a second before we get into central banks, commercial banks have assets and liabilities, and then they have a thin amount of equity that represents the difference between their assets and their liabilities. And so their liabilities are deposits in various forms: checking deposits, savings deposits, certificates of deposit. They usually pay pretty low interest rates, and that represents our assets, their liabilities. Then their asset side is usually higher interest yielding things like mortgages and other types of loans, as well as various securities like treasury bonds or other types of securities that pay a higher interest. And they make money because their assets pay a larger interest rate than their liabilities, and they also charge various fees. And that basically represents their income at the end of the day. Now, a central bank actually works quite similarly. The bank holds their cash at the Fed and earns interest for it. The Fed also has liabilities in the form of all those banknotes that are obviously zero yielding because they're just physical cash. And then they have an asset side, which consists of government bonds, mortgage-backed securities, sometimes other types of assets as well, that historically most of the time have paid a higher interest rate than their liabilities. But what changed starting in last year was that now their liabilities, at least for the Fed, and this I think applies to a number of other central banks, now pays a higher average interest rate than their assets. And historically, the reason why central banks are set up like this is to be somewhat independent. I mean, the idea is that they're not a direct branch of the government. The president can't just give the head of the central bank a phone call and say, hey, we have an election coming up, cut interest rates and boost things a little bit, or we're going to pull your funding. Right? You're supposed to have some degree of separation, even though at the end of the day, the government still sets the terms for the central bank and usually elects people appoints people that oversees it. But by having longer terms and staggered terms that are different from the current ruling administration of a country, there's some degree of separation, kind of like, say, a Supreme Court or something like that, like almost like a different branch. And so that's kind of the system we've been operating under, and it's kind of flipped on its head recently. Yeah, you're going to see this in most things. Any central bank that's rapidly raised interest rates is probably in a similar boat to varying degrees. And that's because, historically, we've had 40 years or so of steadily declining interest rates. And so if a central bank holds, say, government bonds from, several years ago, chances are that interest rates now are lower than their average assets that were purchased over a period of time and generally have longer average duration. And part of their liability side is zero yielding because of the physical currency part, right? So they kind of start with an advantage where it's actually pretty hard for their liability side to have a higher average interest rate than their asset side. And if that happened to a normal bank, I mean, that's if a normal bank has basically negative interest income, And or if its liabilities exceed its assets, it's basically game over. Whereas a central bank is different. And so right now you have a period where, because central banks have raised interest rates so quickly, and for the first time in decades, they have higher interest rates than even the prior cycle, they're at a phase where their liabilities are paying out higher interest rates. And so they have negative interest income. And then this varies based on the bank. But now that interest income is eating away their tangible equity. And so many of them have either on the verge of having negative equity, or perhaps some of them already do. The key thing that a bank does is that they're able to borrow interest very, very low, and then they're able to lend it out at higher interest rates and collect that. And there's very different types of banks. There are investment banks, there are commercial banks. Some banks are very simple, some are very complex. But at the end of the day, what their primary purpose is they're providing checking services, they're providing saving services, they're providing services. But at the end of the day, those are a liability for them, an asset for us. And so they're borrowing money. It's actually insurance companies kind of do the same thing. They collect premiums, they pay out claims, but in the middle, they're holding this big float, and they can generate, they can invest that float. They can collect income on their investments by holding things like bonds, and then therefore that's what represents income for an insurance company. And you essentially see the same thing with a bank. Basically, most of the modern financial system that we built up over a long period of time is this kind of arbitrage where banks are arbitraging the fact that they have a bunch of depositors that are coming and going, but in aggregate, most of their total assets, their total liabilities are not changing very frequently. And so they have this kind of permanent low cost source of borrowing that they can lend out for longer periods of time in slightly higher risk capacities. And by having diversification, by having sufficient liquidity on hand to withhandle withdrawals, most of the time they're fine. And they generate that income, and then they pay themselves, they pay their shareholders. It's basically a big middleman operation, and that's how things work. And obviously, back a long time ago, this was a really valuable service because, if you're talking about, like, say, depositing gold coins at a bank and getting like a banknote for them, you're speeding up, you're getting better divisibility, you're getting all these services. Even today, many of us use banks because we're getting something from the relationship. We're able to, connect into this big global set of ledgers, move money around, not have to store a bunch of physical cash like in our home. Obviously, there are some recent alternatives that we can use, like, say, Bitcoin, for example. But prior to Bitcoin, this is kind of the best we have. And so that's the world we live in.
Yeah, I think a lot of people probably don't, a bit like the whole financial system, but don't really realize how this works. I would, if I was super honest, I would have said, certainly when I was maybe like 18, 19, 20 years old, my assumption was when I deposit money with them, they just hold that money and I then access it, and they make their money off the services they provide me. And like, I know a lot of those services are now, provided like close to free. But I don't think people realize that the bank is actually then taking a risk with your money by lending it out. And also in some ways taking a higher risk by fractionally lend it on a fractional reserve basis, which means that if there is some kind of like global economic crash or some difficult financial situation we go into, there can be a run on the bank and it can risk your deposits.
And that's exactly what happened going into 2008. So in 2007, for example, in the United States financial system, there were $23 worth of deposits for every $1 of bank cash, right? So basically, there's tons and tons of IOUs for every $1 that a typical bank had at deposit with the Fed, or stored up in vault cash, little in their ATMs or in their vaults. And when that starts to, even FDIC insurance or other types of insurance are not enough to cover massive bank failures. Those are meant to cover if one like bank messes up and they go insolvent, the system has insurance to cover depositors so that there's, so that in a typical operating basis, people don't have to worry about their bank failing as long as they're within those insurance coverage ceiling limits. But if you have a widespread failure, where there's all these claims for base dollars that vastly exceed the number of base dollars, and instead banks have a lot of exposure to risky illiquid loans that are either unable to be moved around easily and converted back into cash, or if they are at risk of defaulting and therefore losing a portion of customer deposits. And so what they did back in 2008, in part, was that they created a ton of new base money. And they said, well, we're going to create a ton of new base money. We're going to buy some of those assets to reliquify the system. And so, it's not an exaggeration to say it's essentially like a Ponzi scheme. It's just something that has to keep going and keep growing in order to function.